It's Friday again and time to talk about personal finance. Today's episode is about mutual funds and ETFs, so stay tuned. We'll be right back. All right, welcome to another Personal Finance Friday. We hope you've had a good week and you're ready for a quick discussion about exchange-traded funds versus mutual funds. Mutual funds are easily the most generally understood investment product out there because they've been around a long time and because most people have them in their 401k plans. Exchange-traded funds have been around for slightly less time and are generally less well understood, particularly in contrast to mutual funds. So let's look at the general similarities and differences. Both products offer a way for an individual investor to buy a collection of other investments, whether that's individual company stocks, other mutual funds, or even other ETFs. The most common thing is, of course, for the mutual fund or ETF is to buy individual shares of company stocks to build a portfolio. But in that case where you have a mutual fund or ETF buying other funds, that's typically referred to as a fund of funds. And you most often see this in a target date fund in your qualified retirement plan, your 401k plan. These target date funds invest in mutual funds generally from the same company, whether that's Fidelity, Vanguard, and others. And those are set up to achieve a specific asset allocation across those various mutual funds inside that one target date. Now we'll have another video specifically on target date funds later, so we'll move on. Since both ETFs and mutual funds are assemblies of other investments, they both have expense ratios or fees that go with purchasing them and owning them. ETFs, however, are generally lower than mutual funds on average. There are some very inexpensive mutual funds, of course, but again, on average, ETFs are lower. The biggest difference between ETFs and mutual funds is how they're traded and treated in the market. Mutual funds can't be traded just any time you like. The share value for mutual funds is something called the net asset value, or NAV. And that can only be determined at the end of the trading day when all the underlying investments contained in that mutual fund have been settled and their values determined, and that can be rolled up into that one net asset value share price. This valuation method means that you can't trade the mutual fund until the next day based on the previous day's closing price. So there's no way to quickly get in and out of mutual funds. ETFs, on the other hand, can be sold on a whim just like a stock. So you can go in and buy an ETF at 9 a.m. You want to sell it again an hour later? Go for it. You can do that. If you want to sell ETFs short, you can certainly do that. You want to buy ETFs on margin? You can do that too. There are even ETF options and ETF futures investments you can get into if you're up to that kind of thing. Not so with mutual funds. This difference in trading capability is really what separates the two. If an investor is the type that wants to trade frequently, then ETFs are the way to go because you can. So intraday trading is completely possible with ETFs. The trick is, if you are an emotional investor, this can be very, very dangerous. Because if there's market news that comes out that causes everybody's hair to go on fire, you could make a mistake and sell at the wrong time when, if you waited, by the end of the day, everything may have corrected itself and nothing's changed, or the market may have even gone up. But you've bought and sold and created taxable events, incurred losses, etc. Now with a mutual fund, of course, that couldn't have happened because you couldn't trade it on a whim. You would have had to have waited until the end of the trading day, and in fact, all of those other things had settled before your new net asset value had been calculated. Both ETFs and mutual funds are great investment vehicles. We use a lot of them for different purposes depending on the client. Which one you choose depends on your personal investing style, what your goals are, how you like to do things, etc. If you're using a taxable account, perhaps at a discount broker or something else like that, with access to the entire market, you can do any of these things. If you're looking at your qualified retirement plan, your company 401k, your options are going to be much more limited, of course. You're limited to what your company has decided to include in your list of funds. Now, whether those are ETFs, mutual funds, or both is up to them. All right, that's it for this episode. As always, please feel free to put any comments or requests for future episodes in the comments below. Hit like, give us a share if you would, and then have a great weekend. See you next time.